Back in 1928, Charles Merrill, who ran Merrill Lynch, told people to get out of the market.
Mm-hmm.
And he was right in a certain way, but actually very wrong in another way. Between the beginning of 1928 and September of 1929, the stock market went up 90%. So if you had listened to Charles Merrill, you would have not been the happiest camper. This is why it's complicated. And even, by the way, interesting, I think most people don't know this about 1929, the market dipped by 50%. You couldn't call it a dip, a crash, 50% by November 13th. But by the end of the year, the stock market was only down 17%. Now, the reason why so many people lost their homes and were effectively flushed out of the economy and scarred by this was they had taken on so much debt to buy stocks that when the market did go down by 50%, it wasn't that they just lost the equity value. It was that all of a sudden they owed 10 times that effectively to the banks.
Hey everyone, welcome to HerMoney. I'm Jean Chatzky. I don't even need to preamble this for all of you. Andrew Ross Sorkin is my guest today. Andrew's new book, 1929, Inside the Greatest Crash in Wall Street History and How It Shattered a Nation. It takes us deep into the lead up to the crash and what it meant for millions of Americans. It's not just a history lesson, it's a wake-up call. Because as we head into the last quarter of 2025, he says some of the patterns from nearly a century ago are starting to feel a little too familiar. Andrew Ross Sorkin, welcome to HerMoney.
Oh my goodness, it's so great to see you. I'm so excited to be here with you.
I'm thrilled to have you, and I just want to start with the big fat elephant in the room. How likely is a downturn like we saw in 1929, and what is your best guess as to when that might happen?
Oof, it's unfair because I only play an expert. I only play as an expert on TV. My sense and my hope is that we won't have a crash that leads to a Great Depression like 1929. But I do think it's almost impossible not to believe that we won't have some kind of crash that is more akin to what happened in 1999, which is to say that we had an enormous internet bubble.
Mm-hmm.
It was an exciting technology. It's still with us today, obviously. But there was what some people would call a massive, massive correction. And I think when you look at what's happening today in our economy and a lot of the imbalances, but really the excitement and euphoria around artificial intelligence and all of the, frankly, indiscriminate spending that's going on in that space, which is similar to what was happening in the late 90s, it wouldn't be surprising to me if there was a big pullback at some sort. But the truth is, and you know this better than anybody, it's always paid much better to be a professional optimist than a professional Cassandra.
100%. You pulled one of my famous Hemingway lines out and put it in the book. How did you go bankrupt? 2 ways. Gradually, then suddenly. I loved it then. I loved it when John Green riffed on it in The Fault of Our Stars. So how similar are we to 1929? And when you look at the data, and you look at more data than anyone I know, what else besides the massive spending on AI are you seeing in the numbers?
Well, so there's a couple of things going on. One is there really is a sort of sense of euphoria around artificial intelligence, a sense that it's going to change everything in the same way that in the 1920s, there was technologies like automobiles and telecommunications and radio that people thought was going to change everything. And it did. But as a result, people way overspent. At the same time, I always think that every crisis is the function of leverage, too much debt. That is the match that lights the fire. And right now, there is the beginning of lots of leverage in the system around artificial intelligence. Consumers are taking on more credit than ever. So there's a number of things in that vein that I think are anxiety producing to some degree. And then on top of that, there's this other layer that was very prominent feature of the 1920s was this idea that we wanted to democratize finance. We wanted the ordinary investor to be able to get in on the action more than ever before. And that's happening now in a completely new way around things like crypto and private equity and private credit and venture capital, all of which are going to be in our retirement plans soon and available at retail. And by the way, some of that crypto and meme coins, those are also super leveraged. I mean, I don't know if you've looked, there are option trading and other things that people are doing. You could be buying Bitcoin 20 times leverage, 50 times leverage. There's some wild things going on out there.
I have been watching the consumer debt numbers just like I was watching them in 2006, 2005. I started to get worried back then when I read this nugget that we owned less of our homes than we had in the past, that we had just started pulling equity out of our homes because it had gotten way too easy. When it comes to consumer debt, are we ever going to learn the lesson of taking our feet off the gas, taking our foot off the gas a little bit? There's this feeling in the air, and I think it was true in 1929 as well, and it was certainly true in 2008, that people believed that they couldn't lose. And that is what got behind the borrowing. Do you sense that we're in that kind of mania again?
I think that we unfortunately are in a bit of that mania, and there's a keeping up with the Joneses kind of mentality. YOLO, you only live once. I think social media feeds it with a lot of FOMO, fear of missing out. And I think there's a whole generation, by the way, that I don't want to say grew up during the pandemic, but that pandemic period actually, where a lot of people had a lot of cash because they weren't spending it on commuting to work and buying lunch and doing all of those things, and it sort of went to all sorts of other things. I think it's actually led people to extend themselves even more now than ever before. Also, the sort of buy now, pay later, I call it buy now, pay never phenomenon that's taking place. We have more ability and facility to take on this kind of credit. And look, I think the lesson, whether it was the folks who were living through 1920s or those of us living through the 2020s, is humanity always wants more. We always want more. There is a semblance of greed among us. I hate to say it, but it's who we are.
Do we ever feel as if we're on the verge of a crash? I mean, in light of that always wanting more, my husband sent a note to our financial advisor actually yesterday. He copied me on it. He's like, this is just getting frothy. This is frothy.
Right.
I'm getting worried. We're closer to retirement than we were the last time that this happened. They're going to tell us to stay the course. I know that, but
Right.
I want to have this conversation. And to me, that's him feeling like we're on the verge of a crash. And I'm pretty risk averse as well. So I always feel like we're on the
Right.
verge of a crash, but I don't think that most people do.
I don't think that most people do either. And I think even when they do and they see the market continuing to go higher, they say to themselves, again, they fear of missing out. I mean, I remember go back in 2003, 4, 5, every year there was a new article, a new cover story somewhere saying that we were in a real estate bubble every
Yep.
year. And if you didn't buy a home in 2003, I know people who didn't own a home in 2003 who said, you know what, I'm going to wait a year because everybody's saying there's a bubble. It's going to pop. I'll buy in 2004. 2004 comes along, the market's up 10, 15%. The same article comes out again. They say, okay, I'll wait till 2005. They get to 2005 and they say to themselves, I think the train's leaving the station. If I don't get on the train now, I'm never going to get on the train. And of course, that's always the problem. Timing is impossible, but timing is so important. So in the context of, depending on what your time horizon is, you talk about this a lot on the pod and in your writing, if you are retiring or you actually do need the cash and you're worried about a crash, yeah, it might be worth having a rainy day fund that's available to you. I wouldn't suggest otherwise. On the flip side, if you have a 10, 20, 30-year time horizon, I like to believe that you will be better off in 30 years having stayed the course. Back in 1928, you'd appreciate the story, Charles Merrill, who ran Merrill Lynch, told people to get out of the market. And he was right in a certain way, but actually very wrong in another way. Between the beginning of 1928 and September of 1929, the stock market went up 90%. So if you had listened to Charles Merrill, you would have not been the happiest camper. So this is why it's complicated. And even, by the way, interesting, I think most people don't know this about 1929, the market dipped by 50%. You couldn't call it a dip, a crash, 50% by November 13th. But by the end of the year, the stock market was only down 17%. Now, the reason why so many people lost their homes and were effectively flushed out of the economy and scarred by this was they had taken on so much debt to buy stocks that when the market did go down by 50%, it wasn't that they just lost the equity value. It was that all of a sudden they owed 10 times that effectively to the banks.
We focus, as you know, on people's personal economies on this show. We try to take what's happening up here and bring it down to a level where we can use this information to sort out our own lives and make some smart decisions about getting to the future that we want to get to. If you talk to many middle-class Americans right now, they will tell you that it's rough out there, that they are looking at their health insurance premiums that are going to soar next year, that they've taken on too many of those buy now, pay later packages, that they lost their job and it's taking them a lot longer to get the next one, even if they did everything right, like go to a coding boot camp, right? How do we put this into context? The fact that the market is over here going great guns, and yet there are so many people who are just not feeling it. And as a follow-up, before you even answer, should those people be looking at putting their whatever money they have to work as a way to dig themselves out of this hole?
I think it depends on, again, how much time you have, how much patience you have, and what kind of, I hate the phrase risk tolerance, but, how much risk you're prepared to pay and what kind of nest egg or rainy day fund you already have. For example, I've never been a crypto guy. And by the way, maybe wrongly, at least thus far. There are people, obviously, who have been investing in crypto, and that's been like a lottery ticket for a lot of people. Usually I tell people you need to avoid lottery tickets because usually in the lottery, most people lose. For whatever reason, if you bought into Bitcoin over the last decade, you were, on the whole, a winner, a big winner, a shocking winner, actually. So I think I don't want to say that the market is a way to dig yourself out of a hole, per se. That sounds like going to the casino and placing all your money down on the blackjack, doubling down and sort of praying. And that doesn't seem like a great idea either. But I do think that people should generally, on the whole, again, if they have a long time horizon, be in the market. That has been a winning formula for a very long time. But I recognize that a lot of people don't have the cash to even do it. And so that is actually the hardest part about this right now.
Yeah, 100%. One of the most fascinating characters in your book is Evangeline Adams.
I love Evangeline Adams.
Evangeline Adams, an astrologer known as the stock market seer, famously said the Dow could climb to heaven. We don't turn to astrologers for financial advice. At least I don't turn to astrologers for financial advice. But we have Fed chairs. We have Jamie Dimon. Right. We have Buffett. And Jamie Dimon just recently warned that the risk of a crash is higher than people think. In moments like this, who are you listening to? And how do we cut through the noise and focus on what matters?
Oh, this one is so hard because Jamie, I think, look, I have great admiration for Jamie, in part because he's been very cautious over all of these years. And he's often preaching caution. And he's preaching caution now, but by the way, he was preaching caution 3 and 4 years ago as well. And so if you listen to that caution, which I think is very valuable, you might have said, okay, I'm going to take my money out of the market, or I'm going to put a little bit extra over here. And if you have a lot of money, you can do that and you can afford to do that. But if you hadn't been in the market these last 4 years, you would have a different opinion of this entire situation. So I think the important thing to do is to try to weigh a couple of different sort of Yodas or Evangeline Adams in your life, which is listen to a Jamie Dimon and try to understand what he's anxious about. But I also do think you need to listen, oddly enough, to folks like Jensen Huang, who runs NVIDIA, or some of the folks who are involved in this technology, who saw something that a lot of other people clearly didn't and have become very successful doing it. Now, one of the things is, as you become more and more successful, there's another character back in 1929 called Charlie Mitchell. They used to call him Sunshine Charlie. And he was a little bit like a Jensen Huang because he always was an optimist all the time. And as things got progressively higher, he didn't temper his optimism. He doubled down on his optimism. So I think you just have to be careful about all these things. But I'm more in the Warren Buffett camp of what he tells his family members, which is buy these indexes and hopefully go about your day.
Is that a product of having worked at the Times and CNBC for such a long time? I mean, when I was at Smart Money and Money, we were restricted. We were just not allowed to buy things. It was very hard to buy anything because you could be reporting on it the next week. And so
100%. So for me, I'm not allowed to buy individual stocks. And that's so that I can talk about these things independently. That's because I'm privy to inside information and all sorts of other things. So there's a lot of reasons that I do that. Having said that, the truth is that my little S&P 500 index mutual funds and other things have, for the most part, outperformed most professional managers who do this for a living. So if you go back 20, 30 years that I've been doing this, it's not clear that had I been able to buy stocks individually, that I would have outperformed everybody else. In fact, the truth is I probably wouldn't have.
what do you think the lesson in that is for individual investors? I run an investing club with Karen Feinerman for women. We teach investing to hundreds of women every other Monday night on Zoom. And we know full well that many of the women in our club, index funds, ETFs, that's what they're doing, but want to be able to participate in the conversation, and that's why they come. So how do you think that individuals should be?
Well, look, the one thing I do over the years is, even though I'm buying index funds, and I said it's so hard to time things, I do think I've been decent about timing things over time. I've gotten it wrong, but I think if you're part of the conversation and you understand hopefully some of the cycles and where we are in cycles, you can allocate more into an index fund in particular moments and maybe sell out of an index fund and maybe move it in other places. I don't do that regularly at all, frankly. But, there have been times where I decided, I'm going to keep a little bit of cash on the sidelines. And then there's been moments where it looked like the market on a historical basis was dropping. And I thought to myself, okay, you know what? On a relative basis, this thing is off now 10, 20% compared to history. This is probably a better time to put that cash to work in that way. I probably haven't been as good about selling when things have gotten higher than they should be.
One of the things I think you do so beautifully in this book is bring real humanity to the people behind the numbers. They weren't all villains. Many of them were just caught up in something bigger than themselves. Why did you decide to tell the story this way?
Look, I think a lot of people look at the world and at crises like this, and have written books, by the way, about this period of time and other crises in the context of economic cycles and political structures and numbers and charts. But to me, every story is a human story. It's about people who make decisions, oftentimes bad decisions, and what are their motivations and what are their incentives. And if you can understand that, by the way, it's those people and their decisions that lead to these economic cycles. And so to me, if you can tell that story of who they are and you can feel it and you can understand it, you can also then start to understand everything else going on around it. It's a way into this remarkable period of time. And selfishly, I'd written this book, Too Big to Fail, about the 2008 crisis. And after that, people used to ask me all the time, how does it compare to 1929? That's the famous crisis that everybody knows about. And yet, I didn't know much more than anybody else. I think we all thought something very bad happened in 1929, and then the Great Depression happened. And I thought, who are the people? What are they doing? What were they saying? Who are they having affairs with? Why are they doing all of this? And that was the story that I set out to tell through really going back in archives all over the country, in fact, the world, to get letters and memos and diaries and transcripts and depositions and all sorts of material so you could actually be with these people really for the first time.
Were you surprised in the treasure trove of information that you were able to dig up? Did you have a sense that it was there? Was it easier or harder than you thought it was going to be?
So I had a head fake in this project, to be honest with you. Very early on, I landed on what I thought was a mother lode of information around a character named Thomas Lamont, who was running JP Morgan. And I thought to myself, okay, good. This is amazing. Now I can do this. I'm sure all of my main characters, there's archives like this. And actually, I went back to the archivist and I told her what I was trying to do. And she said, you're not going to be able to do this. This doesn't exist. There's not an archive or two or three that you can just go mine. It's just not available to you. And I took that as a personal challenge. And she wasn't wrong in that there really weren't one or two or three places. It turned out to be this sort of mystery of a puzzle that I was trying to piece together in this sort of very complicated way. So one of the reasons this project took as long as it did, it took 8 years, was just the difficulty and challenge of finding the kind of granular detail that could get you in the room and make you feel like you really were there, and so you could understand their characters and their motivations. And frankly, their insecurities. A lot of times I feel like people at the top are being driven by something to prove. They're trying to fill some kind of hole. Money is oftentimes just a proxy for something else.
100%.
And I felt that a lot of the time I spent was trying to understand these people as people, so that by the time you could see them making these decisions, even the bad decisions, the decisions that seemed irrational in the moment, there was some rationality to it because you understood where it came from.
You write that aside from people like Richard Whitney and Albert Wiggin, most of the major financial players didn't necessarily do anything worse than what most people in their shoes would have done. That the markets are messy, and as you're saying, the greed often cancels out greed, and sometimes that's how we get to fair prices. As you look at the litany of characters in this book, who are the ones that you want us to learn from most, and what lessons do you want us to take away?
So there were people who made terrible decisions and immoral decisions, but as you were describing, there were no rules back then. There was no SEC. There was no insider trading. It was a true battle of wits against wits. And what's so interesting about that is whoever's buying a stock thinks that they're smarter than the person selling the stock. And whoever's selling the stock thinks that they're smarter than the person buying the stock. And so a lot of the sort of manipulation that was going on even back then when there were no rules was a function of the fact that people thought that was just another way to outwit the other side, if you will. I think the characters that matter are people like Charlie Mitchell. He ran a bank called National City, become Citigroup. He really developed modern credit. He called himself Sunshine Charlie, and he was somebody who was, he said he wanted to sell stocks like they were neckties, take the mystery out of all of this. But he never really relented in that optimism. And there's a question mark about sort of whether that optimism was therefore misplaced. And I think his own personal story, he ultimately gets arrested. I won't tell you what happens after because it's just fascinating. Does something with his wife that gets himself into a lot of trouble. And I think a lot of people have different views of what Charlie Mitchell did. He was really the Jamie Dimon of his time. He was that famous on the cover of magazines. And then the other person that I actually think is two people who are fascinating characters that we can learn from. One was Carter Glass. A lot of people may know Carter because Carter Glass was a senator in Virginia, created the Glass-Steagall Bill, which broke up the banks in 1933. He was the Elizabeth Warren of his time, and he was the Cassandra in the room. He was the one saying, in fact, he was saying Mitchellism. Charlie Mitchell was going to ruin America, all the speculation, everybody going crazy. And how do you tamp down that speculation? And that's a very interesting question even today. If you're the Federal Reserve or you're a policymaker, if you think AI is going too crazy, how do you tamp that down without tipping over the economy?
Do you think our current system has the guardrails in place to prevent something, an occurrence like we saw in 1929? Or are there other policies that you would tee up if you were running Washington right now?
So if I was running Washington right now, the thing that has me most worried about what's taking place in the stock market today is the emergence of these new financial instruments that I mentioned earlier around crypto and private equity and venture capital, all of those things. I think anytime the new products emerge, and I'm not against innovation in finance, I think it would be great to have access to more of these kinds of things as well. It's that it has to come with transparency. Just 5 years ago, there was this amazing, you talked about SPAC boom, blank check boom. And invariably, people thought that was a lottery ticket. And it was like a lottery ticket because most people lost and very few people won. And that was because the incentives were not aligned, the transparency wasn't there, people did not really understand who was collecting the fees and what was happening. And here we have a whole new boom taking place in these new structures that effectively are taking the guardrails down around things like transparency, taking private assets that have no disclosure requirements and effectively putting them in the public markets with leverage, no less. So I think those are the things. People are going to be buying some of these instruments. They look like stocks in a way. You can buy them any day. But the truth is, if you read the rules, if you read the fine print, in some cases you can't sell them on any day. If too many people try to sell them at one time, you actually can get locked up and have to wait to sell them. So there's a whole bunch of new things happening that I don't think the public is fully educated about yet.
No, and that's why this move to put private equity, private credit, crypto into 401ks has me incredibly worried. I mean, right now we have employers essentially standing between that happening, right? The employers are the guards and they have to allow these things into their particular plans. But I agree with you. I think it's fairly inevitable that we're going to see it. How do you suggest that people get the information that they need to make good decisions?
Well, look, my hope is that there will be rules. I'm not hopeful in this moment, actually, there'll be new rules. But I think when these things come to the marketplace, the SEC needs to push really hard on different kinds of disclosure rules, different kinds of auditing procedures. You know, a lot of these private funds have what's called a NAV, effectively a valuation. Who's doing the valuation? Typically, it's the manager of the fund. In the future, I think you're going to want to have third parties, for example, doing some of those things. And so I think we're going to need some new rules around these instruments so that they don't become a problem. And you're right, from the context of the retirement programs, it is the employers right now that are keeping these things from happening, partially because I think they're worried about the liability issues.
Yeah.
And maybe that will protect us, but it will probably only protect us for so long because I imagine some of the financial firms will be the first to start allowing their employees to participate in these things because they're going to have an incentive to do that because these funds will be their clients.
All right. I want to end this conversation on a hopeful note. What's the silver lining in looking back this far? Does understanding the past give you greater clarity as far as the future?
It does, and I'll tell you why. Because even though we had a crash in 1929, and even though we had a crash in 1999, and even though we had a crash in 2008, things invariably have gotten better every single time. I remember reporting, this is 20, 25 years ago, every time there'd be a headline around a war, for example, or a missile would go off or something like this, the stock market would drop. It doesn't happen anymore. And one of the reasons it doesn't happen anymore is because after these headlines that typically meant that the stock market would drop, the truth was we all learned that they were buying opportunities, that over time things get better. And I like to believe, I want to believe that is the case. I actually am very excited about AI and new technologies. And so I do have optimism about our economic future. And in truth, I have optimism about our more broad future. I've got 3 kids, so I have to.
Absolutely. I've got 2 of my own, and I have, yes, a very optimistic viewpoint for them as well. Andrew, thank you for this. Thank you for the conversation. Thanks for writing the book. I'm sure that our listeners are going to dig right in. We appreciate it.
Thank you.